So we will be greeting the attendees.
Good evening, one and all present here. I am Vandana Vyas, part of outreach team. Welcome to the Para's request from SINE starters who wanted to get a detailed insight into implementation of ESOP, that is Employee Stock Option Plan. We decided to open it for the benefit of all startups in the ecosystem. We invite more such suggestions from you all on the topics of your interest that you would like us to take up as part our sessions. Now, before we start, let me briefly touch upon what SINE stands for. Society for Innovation and Entrepreneurship is a leading technology business incubator hosted at IIT Bombay to foster entrepreneurship and nurture tech startups. We started way back in 2004 and over the years have supported 180 plus startups in various domains, 800 plus innovators under various programs with government and work. These startups have support to startups across India. If you wish to join Science Incubation, stay tuned to our social media and website for announcement of various calls for application. Let me now introduce you to Mr. Jalaj and Hardik Bagrecha. Business development for consulting. Is there a problem?
Yeah, it's cracking. Vandana, it's cracking. The voice is cracking.
Yeah, we are fixing that. Give us 1 minute. Yeah, we are fixing that.
Recording in progress.
Yeah.
Am I audible now? So let me introduce you to the speakers for today's session. Mr. Jalaj Sinha and Mr. Hardik Bagrecha. Am I audible now to the speakers for today's session? Mr. Jalaj Sinha and Mr. Hardik Bagrecha. So Jalaj heads business development for consulting assignments at ESOP Direct, which is a leading solution company. Consulting assignments at ESOP Direct, which is a leading solution company in the space of equity-based. Sorry, there's a lot of disturbance. So Jalaj is a chartered accountant with over 15 years of experience in sales, consulting, marketing, partnership and alliance, relationship management, and new market development. He was previously leading the India sales team at HRO platform BPO solutions at Tata Consultancy Services. He also contributes to strategic projects, research, and innovation. His company's service offerings cover the entire life cycle of ESOPs, including plan conceptualization, design, documentation, plan management, compliance, and reporting. Welcome, Jalaj. Our second speaker, Mr. Hardik Bagrecha, is also a chartered accountant and is working as financial controller at Atomberg Technologies, a very own graduate company. Post his qualification as CA, Hardik started career in consulting field and helped various startups. Simultaneously, he also started his own venture in consulting field. Atomberg was one of his early clients, and he later joined them as financial controller to further strengthen the business processes. Currently, Hardik is also an advisor to YFO Consulting, engaged in providing end-to-end startup advisory. Welcome, Hardik.
Thank you. Thank you very much.
While most businesses recognize the significance of having an ESOP policy, many are still unsure how to achieve this goal, notably in option pool, quantum allocation, grants planning, legal compliance. Today's webinar is going to explore the same. The flow of the session today would be, we will start with Jalaj, who would share his insights on putting your first employee stock option plan into action. That would be around 45 minutes. Then we will have our next speaker, Hardik, sharing his experience in implementing ESOP at Atomberg for another 15 minutes or so, followed by a 15 minutes question and answer session with all of you. We have received many questions from the registration forms that you had filled. However, you may type in your questions in the Q&A box during the session, and it will be addressed towards the end of the session. My colleague Prasad Shetty from the portfolio team is here to assist the speakers with the questions that you will be receiving during the Q&A session. Over to you.
Yeah, thank you, Vanna. I think while you were talking, there was a break in between, and we can't help it. That's technology. And since the panel today comprises of chartered accountant, we can always take that leverage that the fault lies on the technology. So I'll begin with brief about what you have said about me. I will just like to add about the organization also. So we can relate with the audience here, which I understand is mostly the founders and people who are budding founders. That we ourselves was first generation entrepreneur when we started ESOP Direct back in 2000. And the aim at that point in time was we never know that we will come this far, the kind of offering or the kind of niche we have developed in this space. So the journey itself from that point to this point has been quite exciting, challenging, as well as satisfying. So that is how we added one more offering, which is meant for early stage companies in our endeavor to serve this segment, where the consulting area, the administration part, the compliances, all of those things gets collected together and offered as one bundle. So we call it ESOP PG. So as you will see that logo there, that is meant for especially for companies who are at early stage or companies who are looking to implement their stock option program for the first time. Now, getting into the topic, let us look at the macro picture first. So startups, if you look at the market size of it, around 50,000 startups have been registered with DIPB. If that is one number to aim at, then that's a quite significant number. Again, the step there as far as the addition which has happened in the last 6 months or 12 months is like 10,000. So 20% of that pool has come in the last 18 months, which is again a good sign. I would say a great sign, in fact. Along with the story, we are also seeing many companies which were called startups now, posting their IPOs, and also the increase in the number of unicorns, which is expected to touch more than 100 in next 3-4 years. So that kind of segment we are looking at, and in that segment, if you look at the stock options part of it, as per one study which was recently published, around $5 billion is the wealth of ESOPs which the employees have created for them in this segment. So good story for the companies, good story for the employee. And with that, I would like to now share my presentation and talk about the importance of stock options. How does the company look at implementing it? What are the business practices around? What are the regulations which affects ESOPs and one needs to take into consideration? And then we'll also see what are the key takeaways from this session. So I'll just share my screen with you, where I'll be sharing my presentation. Just give me a moment. Yeah, I'll be switching off my video in between so that we don't incur another bandwidth lag. Yeah, I hope my presentation is visible to all. Vanna, this is visible?
Yes, it is.
Yeah.
Yes, it is visible.
Yeah, so the first slide, I'm going to talk about the importance of equity incentive for the employee. And, there would be, what commonly comes to our mind is retention of employee or hiring of talent, or for that matter, rewarding the employees. I think these are the common objectives which everyone know and everyone talk about it. I have added some detailing over it where we can see in some more light. So basically, as you know that this segment is growing quite fast, and especially the area of tech startup where the challenge would be the right quality of talent. So to address the need of having that sort of hiring, especially at key position, and the ESOPs is a key tool. It will help in your recruitment and also negotiations when you talk about compensation. Typically, when we say startups, we know that the deep pockets initially might not be there. So in such situations, ESOPs can come as a balancing factor, while on the other side, it saves cash outflow, whereas the potential of this instrument can be quite astonishing. So recruitment and with the making the attractiveness of the compensation while saving on the cash outflow are the two important aspects. When we look at the journey of the company, obviously the key team members have to be there for a substantial period. We don't want to look at new hirings after every 12 months. So the this ESOP program is flexible enough where we can have vesting schedules, vesting period, where we can achieve those retention objectives. It encourages the sense of ownership. So basically, stock options allows the employee or the participant to become the part of the cap table at certain stage, and hence he sees much more attachment with the company, where his engagement is not just an employee, but also someone who's going to take that piece of ownership. From an employee perspective, when we look at wealth creation opportunity, typically in a situation where just assume there are no ESOPs, those wealth creation opportunities will be very limited. One of that is when the employee retires. So that is the point where the employee would get all those savings and investments which he would have done during his years when he was working. But then at that point in time, there might not be much left in him to do something which is productive. While he can do many things for him, but from a something to create might be very limited. So ESOPs has that potential to link that wealth creation part for an individual, where this can be very early and can also promote them to become founders or create their own enterprise. So linking of organization value creation and personal wealth creation is something where one can look at from an ESOP program. Every startup, from an institutional funding point, is something which they would be aiming at till there is an IPO. And with the investors community, having an ESOP program actually benefits. This is more or less one of the prerequisite for institutional investments to happen in the company, where they will call upon ESOP program or a pool set aside for employees, especially at senior level. This significantly affects the efficiency in the employee behavior, and which can also be triggered with having performance milestones that can be achieved through a stock option program, as we'll see in the later part of the presentation, where even the vestings can have performance criteria which sort of sets milestones in front of the employee that needs to be achieved. So these are the factors, though we may have been knowing it, I thought that it is important for us to look at in this light, where why the company should look at implementing stock option program. Now let us come to the types of equity instruments. So basically there are two types of instruments here, or two branching, I would say. One is where the settlement happens in equity, and the other one is where the settlement happens in cash. So as far as the early stage companies are considered, I mean, the right hand side part of it, where the cash settled instrument, I mean, this might not be something which would be applicable, because startup companies, any which case, they want to conserve on the cash part, and they will look at more on the equity settled side. So in the equity settled, there are basically four types of instruments. One is the ESOP, the other one is stock appreciation rights, the third one is restricted stock units, and the fourth one is employee share purchase scheme. So as far as ESOPs are considered, this is a right which the employee has been given at the time of its issuance, that they can purchase equity at a future date and at a price which is predetermined. So the difference here is ESOPs are primarily issued at market price. The next instrument is stock appreciation right. So here the employee is not required to pay. Typically in ESOPs we have a strike price concept, but in SARs, the appreciation which happens on the equity valuation over different period, I mean, that gets settled in the form of equity. So that is the stock appreciation right. So these are this is again an instrument where the company would not know the dilution as to what will be the actual shares they would be issuing, or the employee would not know that. But the number of shares which will be issued in SARs as compared to ESOPs will always be less. So from a dilution standpoint, the shareholders will have a lesser dilution in SARs as compared to ESOPs. The third instrument there is restricted stock unit. So this is this works typically the same way as ESOPs. The only difference is it is priced at a deep discount or at a face value. So this is basically a deep discounted instrument where the employees will know that their options will be in money from day one, because this is the minimum price at which it can be offered. At times, as the company grow and it raises institutional equity, issuing RSUs may become difficult, because the mandate for the investor is also to ensure that any further issuance of equity happens at the last round or the price round valuation. So that ways RSUs are typically done at the start of the journey when the company is hiring or setting aside the founding team. The fourth category is employee share purchase schemes. So these are direct share award where shares are issued to the employee. Not that much tried out, because here the employee will come to the cap table as a shareholder, and there is no plan also available to the company, because the shares will be issued and allotted. So that ways ESPS schemes are typically limited. When we come to phantom options or a cash settled instrument, so they work just like stock appreciation rights, which you see here. The only thing is they are cash settled, so there is no issuance of equity. There is no dilution to the shareholders. However, there will be payoffs in cash, and also from a accounting standpoint, from an expensing standpoint, this will have a far higher expense as compared to the equity settled instruments. Okay. Moving on. I'm sure everyone would have gone through these terms which we typically see, or we want to discuss or want to ask. So I have captured it here. These are the common terms which are used in stock options discussions in boardrooms or with investors. So let us quickly go through it. Grant is basically the stage where a right is given. It is not an obligation. It is a right which is given to the employee, identified in terms of a quantum of options, and also certain conditions which are called vesting condition. And this quantum of options and the underlying shares will vest over a period. So basically it is a right given to buy shares of the company at a future date at a predetermined price, subject to fulfillment of certain conditions. So here the right is given, but it is not crystallized. So the next is vesting. It is the stage where the right gets crystallized, which means that the terms and conditions of the grant has been met. Now the question is, what are these terms and conditions? So this term and condition can be a time condition, it can be a performance condition, or it can be both. So when the terms and conditions are met, the stage is known as vesting of options, and according to the schedule, the percentage of grant will vest there. Then there is the vesting period. So vesting period is the timeline over which the grants will vest. So for example, if it is a 3-year period, and let's say equated vesting, so 33% will vest each year. Vesting percentages specifies the schedule. So that percentage, what I specified in that example is the vesting percentages. It can be front-ended, it can be back-ended, it can be equated. It can be any way we feel like. So that is the flexibility which is available. There's no statutory limitations to it. Vesting conditions are the conditions which are to be met before the vestings to occur. So as I said, this can be decided by the company and the board and they're communicated to the employees. This can actually help achieve objectives what the company is trying to meet. So whether if this is at retention, so there can be a bullet vesting where everything vests after 3 years, 4 years. If this is something to do with the growth plan, so performance milestones can be decided. The next one is exercise price. So if at the time of buying the shares, the employee has to pay a price to the company. This is known as the exercise price or the strike price, and this is typically fixed at the time of the grant. There is an exercise period, which is after vesting, the time given to an employee to exercise or convey that intention to the company that he's willing to buy those shares is known as the exercise period. Liquidity event is an event where the monetization of vested options happen. So it can be a strategic sale, it can be a cash settlement, it can be an IPO of a company, it can be a M&A or a promoter buyback. So this is where the options are monetized. So the employee will actually receive money against those options. The scheme document is a document which is approved by the company. It is backed by the resolutions, both by the shareholders and the board. And it outlines the plan, terms and conditions, the obligations on the employees, what will happen in case of a change of control, what will happen in case if the company gets acquired, what are the obligations of the employee when he is getting separated, what is the exit event, what is the exercise period. So basically this is the primary document along with the grant letter where the individual quantum and the terms and condition are identified to be referred along with shareholder resolution for any questions which comes on the ESOP program for discussion or for interpretation. So these are the terms we may be knowing. I thought that it will be good if we can just revisit it. Now let us look at from a example standpoint. So this is a timeline starting from 2021. So the first stage is granting of options where the employee is identified and the options are granted. The terms and conditions are specified in the grant letter. The scheme is approved by the shareholder, and the grant will come into picture applicable from the date when the board has approved of it. So in this example, I have had 3 vestings. So the first in the 2022, which is the first year, the 12-month, we can call it a 12-month cliff also. So there is a 33% vesting which has happened. If the employee decides to exercise, he can decide by paying exercise price for 33% of the vested options or any percentage which is lower than that, and the company would have to issue shares to him. At this point, the employee would also be required to pay a perquisite tax, which will be the difference between the FMV at the time of exercise and the exercise price. So basically the notional income is getting taxed at the time of exercise. So in 2024, let us say in the third vesting, when the 100% options are vested, there's a liquidity event. The employee now can exercise the balance. He's again liable to pay the tax as he did in the first exercise. Suppose there is a, that event happens where he is selling those shares. So at that time he can sell those shares, and he has to pay a long-term or a short-term capital gain depending upon the holding period. So for this, the first exercise where he has been issued shares, since assuming that the 24 months period has elapsed, so the period of holding is more than 2 years, you will have to pay a capital gain, which is long-term in nature. Whereas if he's immediately exercising and selling it, it will be short-term. Okay. So by this example, we can see that what are the different events which happens in stock options plan from an employee standpoint. Okay. Now let us come to the company side of it as to what they have to do to set up a program. I think there were questions which were raised also in this regard that we want to implement a program and what we need to do. So I think this slide will help answer those questions. So one is to the first thing is to identify the eligible employees. So whom we want to cover. Do we want to give it to everyone in the company, or we want to reserve it to certain level, certain roles, or to certain criticality of employees? I think that is the first step in the identifying the employees there. We also need to set aside the option equity pool. This is again a question which will be asked by many of us as to what will be that pool, whether this should be 20%, 15%, 10%, 5%. So I have a slide on it, but the pool has to be set aside. This is an important part because many of us would not have raised institutional equity now, and there's also a pitfall associated with it. So I'll talk about it. Selection of the instrument. So which instrument we want to go with? The types of instrument I have mentioned there. So whether we want to discount it, so mean to issue RSUs, or we want to issue that market price like ESOP, or we want to issue SARs. I mean, those things need to be taken care. Phantom is also a choice where the company cannot dilute or is sitting on a high cash reserves. They will use a phantom as a instrument or in a combination. We also have to get a share valuation done from a registered valuer, because at the time of the grant, since this is a issue of equity at a later date, so from a company's act requirement, we'll have to get a RV valuation done. This is the independent valuation of the company to know what is the share price. Accordingly, on that share price, we can offer discount or give it at that same price. Okay. So after having these decision points, we'll have to fix up the strike price, define the vesting schedule condition, identify individual allocation, also work on the separations and the exit mechanism to now lay out the entire framework. So this will be like a ESOP term sheet, which the board or the investors will agree upon, and then it will be translated into a legal document, which we call as a scheme document. Along with that, we'll also have to get approval from the shareholders in a formal meeting. After we have prepared our scheme document, resolutions has been approved internally, the letters will be issued to the employees, qualifying what are the terms and conditions. There can be different terms and conditions for different individuals, different functions. So, a particular function may be treated differently as compared to another function, but initially we don't see those many combinations coming up. So basically it is all driven to one terms and condition across the board. So along with that, the employee communication and the sharing of these letters, which will mean that your grants have been finalized, it has been issued, and it's been on the record. Okay. Yeah, so I was talking about one of the major decision point in the implementing our stock option program is setting aside an option pool. So basically this is a balancing act, and there are two approaches to it. One is the top-down approach, where we need to know let's say what percentage to set aside. So let's say, for example, type of startup, whether this is a tech startup or a non-tech startup or a services startup, what sort of a startup we are. And then identify the data point there, look at industries, look at companies, how much pool they have set aside, and aim for that number. Similarly, what is the founder's skill set? So are the founders more from a business standpoint, or they themselves are technology oriented? So which means that their contribution to the product would be significant, and they will also take part of in the taking it to a commercialization stage. So what is the founder skill set? So typically, if the founders are more tech oriented, they would themselves would have created this product. So the percentage requirement might be lesser in those companies. What are my hiring needs? So what sort of positions I need employees for? Is it like more like a key roles, or managing certain functions? Is this type of a position I'm looking at hirings, or this is like support functions, or within those technology or product or business function, this will be more like entry level position. So what are my hiring needs? Whether I need qualified people, need well experienced people, or I can manage it with people who are less experienced. So those things also will have a play on the pool to set aside. So typically, where the requirements would be on a where this is more tech oriented or more experienced people, the importance of their role in the company, the number would be higher. Team size. So what is my team size currently, and what will be in a steady state? So I also need to take into account certain strategic reserves for my ESOP pool. I don't want to consume everything upfront. So the team size for a steady state business, I should have a view on it, and also what will be my current coverage, so that I can provision my pool. So that also is a factor. Talent pool available. So basically, if this is a skill I'm looking at, what is the talent pool available in the market? If it is a very hot skill, we might have to have a higher pool size in our company. Then many times, or in fact all the times, you will see that investor term sheet will talk about how much equity to set aside for ESOP, and that will also give you a certain number which you will have to aim for. So basically, this is a top-down approach where you start with a number, and that for the type of business you are, or the kind of skill set you need, or what is your talent pool availability, or what is there in the term sheet, you will define the percentage. Okay. Then there is the other approach, which is the bottoms-up approach, where you look at what is my coverage out of 10 employees, whether I would be covering 5 or 6 or all of them. So the requirement will be based about from the coverage point of view. You estimate the valuations of the company, so how much the value the company would grow to in that plan period. So that is another estimation one has to do. From the criticality assessment point, this is important because now you will be using certain multiples. So if this is a employee who is at, let's say, the highest criticality, should be making let's say 75% annualized CTC worth from a stock option program, which means like 3x in 4 years, or like or more than that. So those criticality and the metrics which needs to be applied, the multipliers which needs to be applied there, so which will help in determination of the award for this individual. So that is again, that's something we can do. And how much benefit the employee should be making. So whether it should be out of the current CTC, it should be 5x, 6x, 4x, whatever that is. So we'll have to do a calculation basically here to arrive at how much equity needs to be issued for a particular number or a quantum which the employee is expected to make during that plan period. And basis that, then we'll have to decide grant frequency and the strike price setting up. So this is basically the bottoms up approach. I think the best approach is where we balance it out, where we look at the top down, the percentage for our company, and industry, and the other elements which will drive it, along with how much equity needs to be given to an individual, and total it up to arrive at a dilution of the company at the org level, and sort of balance that out. So These are the two approaches basis which the pool is set aside. Once the pool is set aside, then we can start granting options, which can again be bifurcated into hiring grants, which are typically made at the time of onboarding, especially when you are attracting a talent at a very key position. This would come your way. Their expectation would be to have onboarding grants. Then time-based retention grants, where you stagger the vesting schedules or you do a bullet vesting, where you ensure that the employee stays in the system for longer time. Along with that, performance grant, where after the end of the period, every year you can appraise the performance and accordingly make a grant, or make a grant in anticipation of a performance, where you set certain milestones as vesting conditions. So performance grants, then top-up grants if there is any dilution which happens due to further fundraise. One can also top up the grants to an individual by adding a pool and then making a fresh grants there. Along with that, if there is a level promotion when you scale up, and now the hierarchies and functions are well defined. So if there is any promotions which are happening, there also a grant can be issued. So this is a sort of setting up a career path and better engagement model for the employee in the organization, which is suited for your hierarchies. So this is how one can define the pool size and start defining a scheme where what types of grant needs to be made with a sort of a long-term planning there to ensure that there is substantial reserves which are available for any lateral hires, or for that matter any top-ups or future grants one has to make. The next slide talks about the regulation. I think there were many questions which were raised around what is there in the Companies Act, how do we do valuations and the accounting. So I thought I should capture it in one slide. So as far as Companies Act is considered, before 2013 Act, in the 1956 Act, there was no specific rules for ESOP. In 2013 Act, the rules have been now incorporated, and these are more or less synced with the SEBI regulations, which is applicable to the listed entities. So ESOPs can be given from eligibility standpoint, it can be given to employees. It cannot be given to consultants or agents in the company. It can only be given to employees or whole-time directors. It can also be given to promoters in certain situations, which is where they are the startup is registered with DIPP. So in some cases, we can give it to promoters, but promoters are also not eligible for equity options grant. We will need independent directors are also not eligible. We will need for the approval part of it a shareholders resolution to approve of the scheme. This is a special business where what goes in the resolution, the shareholders need to approve of basically the pool, the eligibility, what is the minimum and the maximum vesting period, what is the accounting we are following, what is the vesting period. So there is a resolution which the shareholders have to approve of. It's a proper defined resolution along with the explanatory note. And then we also need to have a scheme document, which is the further detailing of the program followed by individual allocations and terms and conditions. So Companies Act, the process here is pretty much simple. It requires the shareholders approval, and in our case, since the company will not have many shareholders, it is not a difficult job. In listed companies, they will take much time to get approval of it because their numbers, the members, is pretty high. Okay. From accounting of stock options, most of the startups in our category would be, if they are following guidance note, then the method which has been applicable to startups in that category is intrinsic value, where any difference between the FMV and the strike price, that difference is treated as an expense which needs to be amortized over the vesting period. However, if the company is following Ind AS accounting, where in Ind AS accounting we have a fair value method of accounting. So fair value method of accounting requires options to be valued under a model which is there are many models for valuing stock options. Most commonly used is Black-Scholes. So this model will be used to value the stock options, and accordingly that value would then accounted as expense and amortized over the vesting period. So it depends upon which standard we are following or which is applicable to us. Most likely is that at the stage where we are, when there will be only be following the intrinsic value method of accounting. From our taxation of stock options, there are two sides. One is from an employee and the other one is from the company. So from an employee standpoint, there are two incidents of taxation. One is at the time of exercise, where the difference between FMV at that time and the strike price is treated as a notional income, and the employee would have to pay tax. This income is chargeable under salaries. So, whatever the bracket you fall into, you would be, as an employee, he will be liable to pay tax, and the company being employer would be liable for withholding tax requirements. So basically the TDS deduction. Once the shares have been issued, the employee later on, when they decide to monetize, depending upon the period of holding, if it is long term, they will pay long term, capital gain tax. The cost of acquisition will then become, FMV on the date of exercise, and the sale consideration, the difference there, that will be treated at capital gain, and the tax rates will be applicable basis whether this is short term or long term. So not getting too technical here, but we need to understand there are two incidents. One is perquisite and the other one is the capital gain. Actually, we are taxing the entire gain from strike price to the sale consideration. This is the gain. One part of it is getting taxed as a salary income, and the other part is getting taxed as capital gain. So, if we see or perceive it that there is a double taxation, both perquisite tax and capital gain, that is not the case. It is the one part is only getting taxed at salary, the other part is actually we are taxing the entire gain. So it's a proportion of that entire gain where it is distributed between salary and capital gain. From a company standpoint, the cost which they book in their accounts, that can be claimed as a tax deductible expense. Though this is not as under the act yet, but there are certain judgments where the company can take claim basis those judgment while they are filing their return. So this is basically from a taxation standpoint. Recently, there was a amendment which was made from a tax standpoint for employees. It was said that this is not very lucrative for the employee to pay tax on the notional income where the monetization has not happened. So those companies who have the certificate from interministerial board, and those were incorporated, especially startups after April 2016, those company can claim the benefit of this provision where the tax liability is frozen for an employee, but it gets deferred by 5 years, or the separation of employee from that company, or sale of the shares, whichever is earlier. So this is another provision which has been added in the last 2-3 years. In the last, so that phase one can claim benefit, from this provision, provided we are registered with interministerial board. Okay. Now coming to the end part of my presentation here. I would like to share some light on the best practices or the business practices. I'm sharing the report of the survey which we did in 2020 for unlisted companies. My aim is not to influence you with any snap judgments, but the idea is to look at what companies have done, especially the unlisted companies, what they have done, and sort of whether this helps in our decision making or a judgment. I think that is a call which every one of us has to take. However, at a principal level, my suggestion always has been that one should look at from a individual company standpoint, case to case basis, what is working, what is their valuation, how the business model is working out, what will be the points of their pivots, how the employees are going to add up, what will be the positions they are going to fill in, how much they will need to grant, what is the reasonable element for those quantum, and then sort of look at these numbers to see where we are, rather than just looking at these numbers from as a queue and just copying from there. So there are certain metrics I will present before you. So when I look at employee coverage, we see that almost 58% of the companies who responded covered only 10% of their employees. So this indicates that the companies are not looking at broad-based coverage. But just as a caution, I said, don't take a snap judgment on it. There are companies who have done broad-based program and done it well also. So this was, we have seen from the response, where most of the majority of the companies have suggested that they have covered only 10% or up to 10% of the employees. On grant frequency, the majority of the companies suggested that they were granting options annually. So what it means is that options, it's not like that we grant and then we don't do any grant during the vesting period or do ad hoc grants. So there were cases where companies said that they did ad hoc grants or one-off grants, but most of the companies have been granting options on an annual basis. Moving to the next slide. On the type of instrument, so we see there's a trend that companies don't want to grant multiple instruments. I think this could be because this will create administrative, more work or effort required to manage those schemes. So, and also the compliances. So to cover that, the majority of the companies have been granting only ESOPs. On the pool sides, again, this is a number which can be seen, not seen in a sense that we have to just follow it, but the majority of the companies have their pool was around 5% in that category. So 5% is what most companies did. The next range was when companies who have done greater than 10% was only 14%, but there are still companies who are giving more than that 5% or 10% mark. So majority of the companies, if you look at around 86% of the companies are within 10%. On vesting period, the 4 years vesting period has been seen followed by almost most of the companies here. So or more than 4 years. So almost 65% of the companies, if you look at this chart, have been having a vesting period of 4 years or more than 4 years. So typically for an unlisted companies, vesting and exits can at times be related. So since exit events are like 5 years, 6 years, but I mean in the last 18 months we have seen exits happening in for ESOPs in less than that. So there are many companies who are doing now within 15 months, 18 months, 20 months, and they're doing it on a regular basis. So, but this trend would come in if we, another 18 months down the line, if we do a survey, we'll see more, maybe a different trend there. But as of now, what we see is more like majority of the companies are following 4 or more years of vesting. The vesting type is preferred to be equated. So 62% of the company have done equal vesting. There are multiple types of vesting which we can do. There's bullet vesting, there is 1 year cliff, then monthly vestings, post that, or a front end vesting like 40, 30, 20, 10, or a back end vesting like reverse of that 10, 20, 30, 40. So, these are the vestings which are available, but the point here which is important is we have the flexibility. There's no statutory bar of having a vesting percentage. We can have different vesting schedules, and it can be different for different individuals also. It is not that this has to be there hard coded in the scheme. So when we define the vesting terms, we can define it in the grant letter, and that can be different for different functions or different roles or different positions in the company. Type of vesting. So, this is again something where in the last 10 years we have seen a different trends emerging. So initially this was more like a time-based vesting, but now we are seeing companies doing both a combination of time and performance, or purely performance-based vesting. So if I were to look at maybe a survey result 5 years, 6 years back, that 54% what you see as a time-based component could be very easily 80% or 85%, and the time or the performance around 5-10% or 15% there. But the performance element is more or less now very close to 46 element in the one way or the other, which is reflecting the fact that whether the companies, whether these are funded, unfunded, I mean, there's an interest of ensuring that the employees get it, but at the same time they should be able to also achieve certain performance milestones as defined in their vesting schedules. The exercise price, the market price is been seen by 54% of the respondent. They fix their stock option strike price with the market price or the FMB. The discount to market price and the face value is 46%, where face value is 19%. So these are RSUs, whereas discount to market price can be any number we can think of. Typically these are deep discounted. So here we can see that the trend is sort of a mix. So companies are doing it both, they are linking it to market price, they're giving at market price, but at the same time they're also willing to discount it. The discounting of market price will mean the additional cost for the company, which they will have to bear. But at the same time, discounting of strike price will reduce the number of shares, which is lesser dilution for the shareholders, because their options will be in money from day one. Typically, when we see institutional investors, once they come in the company, their the stock options program strike price is actually it don't fall below the last round price. So that is more like linking to market price in a sense where from a stage standpoint. So as long as you are seed, pre-seed, or before an institutional investor has come in, or let's say before Series A, you have that liberty of issuing or giving options at typically at deep discount, but later on it has to be pegged with the market price. This is where one caution also needs to be exercised, because many a times while the commitments are made at discounted price or at face value, and the schemes are not implemented, or they are not formally incorporated in the company, and then you have the institutional investors coming in, and then you want to replicate what you committed to an employee. So there, it comes out as a problem, because once they are in, it becomes very difficult to issue options at discount. Okay, so if you are committing options at face value early, which might be a case with many startups, then we should also incorporate the program with some sense in mind that it is a priority element. Otherwise, if you wait too long, it only remains a commitment or gets captured on the joining letter. There is no formal scheme in the company. It might become tricky and difficult once the institutional investor comes in. Okay. Whether exercise price is linked to a liquidity event, when we ask this question, so most of this company, 72% majority, so a significant majority, they responded saying that this is linked to a liquidity event. And this is something which we have been seeing this across most of the stock option program, exercise are limited. These are linked to a liquidity event, which are again not one liquidity event, but there are many liquidity events which can be envisaged. So accordingly, whenever that liquidity event happens, the exercise is allowed. So what it means is there is exercise, and at the same time there is a monetization. Okay. Fixed exercise period, also we see those schemes. So companies where they know that they will hit the IPOs within this period, and which will cover that scenario. they will use it, or companies who want employees to become shareholders and come on the cap table, they can also have a fixed exercise period. The question around trust or direct route, this is again something which many of you have asked during your registration. So if you see the significant, the majority is with following the direct route. Trust route can be done, but it can be done at a later stage also. It has certain benefits, at the same time costs associated with it. So the company, initially when there is not much of a exercise behavior, or for that matter, transactions taking place, the liquidity events happening, when there it is better to follow a direct route rather than a trust route. So this is from the survey which we did. I thought that these data points would help us further understanding the subject and the practices which the businesses are following. So the key takeaways from my talk, which I would like to present here on this slide, is how we can avoid how to avoid those pitfalls in the planning part. So one is one common element there is which we see is setting aside a very large equity pool upfront. So though this might sound that okay, we are setting that pool up, but from a founder standpoint, all that dilution will be with you. The institutional investors, when they will come in, they will put that pool into pre-money, and if the pool is already at a very high level, and maybe ahead of their expectation, they will not dilute later on. Also, you might not use the entire pool initially because the employee population has not increased, the business has not scaled up. So even the unutilized pool will be counted in pre-money, which will sort of overshoot your dilution, and it's not desired. Granting few to too many participants. This is again one area where we need to be careful. I'm not against granting to many people, but granting too few of our options is something which one needs to be careful, because these are wealth creation instruments, and it should have some quantum, some size to it. Also, we need to ensure that when we are granting it to the leadership or people in the important positions, I think there has to be a quantum which is decent enough as far as their roles and their positions are considered. If we, liquidity event is going to be one of the most sought after element of your stock option program when the employees see it. So, how we articulate the liquidity event in our plan is going to be also an important part. So, do we have the visibility of it in the first place? Do we, envisage that the liquidity can even happen before a strategic sale or an IPO? Do company have sort of parallel planning if some of these external liquidity events are not happening, where they can do it through their own sources? So this needs to be visualized with a vision, and at the same time prioritize in your scheme document. Too many restrictions. So having a grant which has too many conditions and terms will sort of reduce the transparency element. So we should have, obviously, the restrictions should be there, it should be well communicated, but having too many thoughts there on the restriction side of it might not work. The employees will see what is there inside, and they will not appreciate it. So while the transparency is a very important part of ESOP success, and that is where too many restrictions with the board is also not desired. You leave open items for the board to decide. So this is based on then the interpretation at that point in time, or what the board will feel like. So that also is something which should be avoided. We should have terms and conditions. We should wait. We should balance this in a way that all the stakeholders, the shareholders, as well as the employee, are gaining out of it. It's a tricky affair, because what works for an employee might not work for a shareholder, and what works for the shareholder might not work for an employee. So there has to be a balance, and accordingly, the restrictions or discussions, your scheme or grant should be made. The documentation is something which we see many times are incomplete or not thought of, or these are templates which are copied from some other scheme or floating on the webs. So copying those documentation has a very high risk, because you never know why those documents, what background with it was written. The last point, and this is again very important point, is employee communication. In fact, many of the program fail because of ineffective employee communication. One needs to set right expectation with the employee, especially when we are seeing so many big liquidity events, big IPOs happening. That story, it's quite natural for us to look at our stock option program with that success, with that sort of replacing ourselves with the positions where the employees in those companies are, and they're sitting on those millions of dollars. So that way, setting the right expectation is very important. ESOP programs may fail also, and we have seen that as well. So as far as communication to the employees is considered, talking about the future vision of the company, setting the right growth path for the company, and communicating it well, making all employee also a stakeholder as far as that information sharing is considered, is going to be key. How this is going to impact their stock options. Many times we see employees are communicated percentage in the company, or some numbers in the company, which is right, which is wrong. I mean, those things will emerge. Typically, it should be numbers of options. At the same time, if that number means certain percentage in the company, that is good. But percentage may change because the equity structure may change, but the number will remain a number. So how those the terms, the conditions, you need to explain it properly to the employee. Any restrictions, what happens if the employee is getting separated, what happens if he is resigning, what happens if there is some termination with a cause. All those things need to be explained out properly for the program to be successful, and getting an engagement and alignment with the founders thinking. So with this, I come to the end of my presentation. I will take the questions when we come to that part. Vanna, so I think I have finished within my allotted time. You can take over now.
Yeah, sure. Thank you, Jalaj. It was a really insightful session, and with a very well summed up last slide to avoid how to avoid pitfalls. So now I welcome Hardik. Over to you, Hardik. Hardik will be talking specifically from the viewpoint of a startup, how they have implemented their ESOP at Attenberg. Over to you, Hardik.
Yeah. Hi. Hello, everyone. So first of all, I'd like to really thank Jalaj for so insightful presentation. It was quite in detail. So I have already, my intro has been given, so I'll start quickly with the topic. So how Attenberg has implemented ESOP is back in 2016, when we started our journey after shifting from SINE. We started our journey with the seed investment. Like Jalaj has already rightly pointed out, there is two kind of approach: top-down approach, bottom-down approach. Attenberg has selected the top-down approach from there, and he has basically selected the pool based on how much employee he will need to run a big company, how much kind of talent he will require, how many leadership roles he is looking for in future, and based on that, the pool was decided. Of course, it was rightly said that percentage of the pool is very important, because from the two perspective. First, it's a dilution for the founders at the time of the creating a pool, and also the investors who are onboarded. It is also that if you create a larger pool at the later stage, you will find that you are giving away the ESOPs, and that would, on a theoretical matter, will reduce the value of your ESOP as well. So, but Atomberg was, if I talk about Atomberg, we were very conscious. The pool was created very rightly with the help of Aarti's. We received our first investment from the Aarti Group, and at that point of time, we created our pool. Um, the two things which I would like to basically emphasize here is that never ever give away your whole pool in the initial days. Try to keep that pool with you for a longer period of time. Obviously, it is advisable to give the right candidate the right amount of shares, but at the same time, giving away whole pool at the initial days is not a good idea overall. It's a perspective game, but from the Atomberg perspective, we have taken that approach, and we were very selective, we would say, in the initial days to give away the shares and while selecting the employees who will get ESOPs, who will not. um, the the question we were answering to ourselves was whether that particular candidate is required to be with Atomberg for next 5 years, where he will be value adding in the overall growth journey, and at what level. Apart from that, what skill set we require, and we allocated that pool for. So these are the broader criteria where Atomberg has set aside the pool in the initial days. Um, Till in next 3 years, Atomberg has given some ESOPs to very selected people. Post that, Atomberg went on raising more rounds. Uh, we also extended our pool in the later days as well. So it's not that the pool which you have created is in whatever thought in the initial days cannot be rediscussed upon. It's everything is a situational based where you are at that point of time. So we have also basically created some percentage of pool, and then in the later stage we have gone and extended that percentage also. And it's totally on the negotiations which you do with your investors, and how much your investors are comfortable with, what skill set you require more to make your company more big from the current scenarios. Um, but definitely, these are the numbers which will impact the overall dilution of the existing investors and also the upcoming one if the pool is created after round. So it's a typical point, but pool is important just to attract great talent. Pool is also important to retain the great talent, and pool is also important to basically award the existing talent if they have done great. So definitely, no company is in a success only because of the founders or only because of the bunch of people. It's a team efforts always. So uh, appreciating them with the pool with the ESOPs is always a preferable option. If I talk about from the Atomberg perspective, definitely the cash is a major constraint which every startup have in initial days. So ESOP is a very great tool which has helped Atomberg to basically attract the great talent. We use that even today. It's not that Atomberg is reached to a certain level, and we now if we can afford to pay, and then also we keep on spending it. We don't spend, we spend very precisely, and we use this tool till now. And this is a very important tool. It's become now more important because the valuation which the company are in, it's easier for the company to basically convince the employees towards the growth strategies and the future prospects of the company, and also the liquidation events as company has went through more and more rounds. So as you grow, the ESOP becomes more important and more valuable to the organization. uh, how Atomberg decided the pool size. So this is something which is very subjective from company to company. I'll talk about from Atomberg perspective. How we decided the pool size is that uh, uh, these a function of two matters. First, how many founders you have on board. Uh, if you have only one founder on board, then definitely you need a higher pool because you need to attract talent, and you need people to manage team on the front end. If you have four founders on board, then definitely you may not require a front end talent, or basically I would say higher managerial skills. So you may create a lesser pool. but it's a function of that how many founders you are in and how many shares you each founder have. That will decide that how much percentage, of course, and the points which have been highlighted by Jalajji, uh, uh, including that, it will decide that how much percentage of pool needs to be created at that point of time. To whom the Attenborough has given, Attenborough in the initial days has selected the people who they thought that they are the person who will be able to scale up with the companies, and basically they will be keep on value adding in the company's growth with their, definitely with their efforts and with their great learning skills. So everything said that Attenborough has also given some of the ESOPs to new joinees as well. So because uh, as we using this tool as to attract more talents and basically having good leadership on board. So yeah, this is the way that Attenborough has approached till now, and definitely in future also Attenborough is planning to keep the tone in the same way for in coming future. Uh, we can say that the giving away the ESOP is needs to be a selective job, because if you give away the ESOPs to everybody, then the notional value of that ESOP in the mind of the employees reduces. If every Tom, Dick, and Harry in the companies are having ESOP, that is also not so good from our perspective. It should be a kind of an elite. So definitely we try to keep that ESOP in that way, in at least in Attenborough right now. Yeah, so this is what Attenborough is all doing about. I have taken a shorter time, so we can actually think about the particular question if we have.
Thank you, Arvind. I'm sure the audience have a lot of questions to ask. I can see a few raised hands also. Prasad, you can.
Yeah.
So I will allow Shirish and Shirish, you can ask your question. We are making you as a panelist so that you can ask your question. Yeah, Shirish, please go ahead. Shirish, you can unmute yourself and ask question. And other participant, we will encourage if you can put your question answers on Q&A chat so that we can ask those questions directly to Hardik and Jalaj. Okay, so I guess Shirish might be facing some problem. I will start asking the question from the Q&A. How to decide the equity percent for board members? And second follow-on question is, what would be the total percentage of equity one startup should keep for ESOP? So I guess most of the question has been already covered in the PPT, but Jalaj, I would request you to please throw some light on this.
Yeah, so the first part of the question as to the board members, I think all board members would not be eligible for stock option grant. That we should consider. So basically, the promoters and the independent directors, they are not eligible. It's only the full-time directors, and they also would be or should be seen in the perspective of how much equity would be adequate for them. So taking into account the multiplier for that level, we can find out the number. From a percentage standpoint, I think percentage, one looks at the overall pool, and out of that, let's say, we're looking at the CEO, side of it, CEOs only in that board who is qualifying for it, then it's like around 50% is for the the CEO of the company who gets that pool. So it depends both from what we are looking at as an individual, and also from a position standpoint, along with what is available as a pool, we can find out that number. The second part of it was one should keep for ESOP. So see, as far as the stage is considered, it's important. And as I said in my presentation, don't keep a very high pool initially. because then as a founder, the startup founder will be the one who is going to take the maximum hit. So from a dilution standpoint, I think the initial, even if you are at a seed stage, I think one can look at between 5 to 10% and the sort of, keep it there. Also, I agree to Hardik that don't consume your pool, too fast, because you will be needing it. I mean, initially, when a company does a Series A, they will realize that they may have set aside 5%, 10%, but the requirement is only coming to around 1%, 2%, because there is an exponential increase in the valuation, and that is where the value of ESOPs also increase. So, setting aside a pool and at the same time, consuming it so that there is enough available as a dry powder there is important.
Moving on to the next question. I hope that answered your question. I can't see any name here. Now moving on to the next question from Sridhar Joshi. What is the right mode to get foreign consultant or advisor on board, not an employee? They are not Indian nationals. I am not understanding the question. Maybe he wants to understand if he onboards foreign consultant and advisor, whether he can give the ESOP. That's what I can understand from this question.
So Prasad, would you like me to come in?
Yeah, please.
Okay. So, typically a consultant is not eligible for ESOP. They may be there. So the important part there is whether they are employees or not. When nationality is immaterial, we can grant to a foreign national provided they are employees of the company or employees of its subsidiary. So far as foreign consultants or advisors is considered, they will not be eligible for stock options here. For them, we would have to think about the other type of equity incentive, which is the cash incentive, where those phantom programs, which are unregulated instrument, that can be opted.
So now follow on question from Sridhar Joshi. Why the phantom more expensive, phantom shares?
Yeah, so phantom is more expensive because you are cash settling it. So the entire appreciation, is going to be booked as a cost. So suppose, for example, today my share price, let's say, is 100 rupee, and I'm going to, settle this off I'm giving it at 100 rupees strike price. So this is a strike price or base price for phantom, and I'm going to settle it when after 5 years, and let's say at that time the price is 1000 rupees. So I have to pay off 900 rupees. Now this 900 rupees is a liability, and this will be booked as an expense. This will be marked to market over that 5-year period. So the entire payoff will come in as an expense. Now on the contra side, let us look at a ESOP. Now ESOP is granted at 100. The market price at that time was 100. What is your cost? Your cost is nil, because the intrinsic value there is nil. Okay. So the cost in phantom would be significantly higher than the cost in equity settled plan, because there you are valuing that instrument on the date of grant itself, and then you sit with that cost.
Okay. Moving on to the next question. Can options to be given to consultant or contract workforce, not on roles of the company? Hardik, would you like to answer this question?
So I think Sridhar has rightly pointed out, Jalaj has rightly pointed out in the presentation as well, we cannot give ESOPs to any of the person apart from employees. He needs to be an employee of the company. So I think that answers that question, that he will not be able to give the ESOPs to any of the consultants.
Yeah, moving to Shirish Arya's question. For non-listed company, how does the price determination work? Jalaj, would you like to answer that?
Yeah, so there is now with the unlisted companies, since this is a matter of equity issuance, the RV is going to value the company. This will be an independent valuation done by an RV, which the company then will be used for determining the strike price. As far as determining the strike price is considered, you have the flexibility. You can give it at FMB or a discount to FMB or face value. So the price determination here will be done by an RV.
Okay. So Next question. How do you manage this ESOP operationally? How difficult is this to manage?
So I think before asking us that whether this is difficult or easy, I think what we should know is what we have to manage. So as far as ESOP life cycle is considered, if you look at, there are actually 4 transactions or 4 events which are bound to happen. This is like grant, vesting, exercise or settlement, or a sale or a monetization. So these are the 4 events which will happen. And on top of that, there would be certain separations, certain new grants which will happen. So these are like data items which is going to get populated and increase over a period of time. So typically, an automation or a data, place where this data can be, managed efficiently is something, one can aim at. And this is done. I mean, it's not that they're not service there. We also have this, operational capability of managing, programs. So the automation, the security from a data hosting standpoint, the experience with the employees, what your finance team would need or your HR team will need as a MIS. I mean, those things can be achieved through a system automation. From a difficulty, how this is difficult to manage, I don't think this is difficult to manage. Once you have set up those processes, then it becomes more streamlined and process driven rather than person dependent.
Okay, great. So another question is from Ashutosh Pavaskar. How complicated is the valuation exercise? I guess this has been already answered, Ashutosh. I will move to the next question from Pragyan Patnaik. My investor wants the promoters to dilute their shares to create the ESOP pool rather than issuing new shares. What are the implications?
Yeah, so basically this is what they are saying is that they don't want to dilute. So they are avoiding the primary, because if they do a primary, then the investors will also dilute along with others. So they are saying that the investors should contribute. So the implication is for those promoters, they would be the only ones who will be diluting for ESOPs.
Okay, next question, Hardik, you can answer. Can direct equity to be substituted as ESOPs?
Actually, no. So ESOPs are the options to convert that options into a equity in a future date. So direct equities are the equity which are already been allotted to any of the person, if investor or the promoter. But ESOP is an option. ESOP will be equity only after when it is exercised and basically allotted to the particular employee.
Okay, thanks, Hardik. So another question, Jalaj, which one we should follow? Shall we negotiate the equity percent with employee during the time of recruitment, or shall we issue this after assessing the performance?
So it depends upon the role and the criticality of that position. So if you are hiring a CXO level position, obviously they will negotiate it upfront, and they will ensure that this is part of their joining offer or sort of an onboarding grant. So for those categories, you can keep aside the onboarding component and also set certain portion where it can be granted basis assessing the performance, which can take some time, right? So for those positions, that approach can work. For other positions which are mid-level or slightly lower than that, there you can see the employee, spend some time with the employee, how he performs, what is his engagement with the company, and then take a call. So typically, like waiting for 6 months period at that level and then making a grant can be a approach to see. Hello.
Yeah, next, we will move to the next question. If a company is building product and getting customer is a year away and the valuation is difficult till that point, how can we do any ESOP allocation now to ensure retention?
You want me to take it up, or Hardik, you will be answering? Because I think this you would have seen in your company already.
So I'll take it up. I'll take it up. So basically, what happened is that whenever you negotiate on the ESOP, it's a story you negotiate. It's not about that whether you are doing a sales or not, whether liquidity event is today or not. It's the story what which founder believes, is the story what employee is believing in you, and the future visibility is getting from that, from the founder, and the kind of transparency he is feeling at the time of the onboarding. ESOP is already a future product. It's not that you are getting the liquidity today. It's already a future product. So liquidity is not required at the time of offering the ESOP. Liquidity is something you will have to provide to the employees in a future dates. Definitely liquidity is important if you think about from the employee side. But you no need to give that any kind of a commitment to the employee, but definitely a 4 or 5 year of run rate that there will be a liquidity event in the future is enough. So definitely there is no requirement of having a liquidity event in hand, or basically a sales in hand to for a ESOP in any way.
Okay, moving to the next question. In deep discounted price during exercise of ESOP, is the price determined as a number in INR, or is it a percentage?
It can be both. It can be a number, it can be a percentage, it can be a absolute amount, it can be anything we want to define. It's a price or a pricing formula.
Okay, great. So this question we have already taken. I will move to the Sridhar. Any equity requires to be balanced with equivalent funds for ESOP pool. Where do you show the funds?
Actually, Sridhar, we don't need to have any funds to balance the equity. So ESOPs are an option which company has given. It's out of the cap table. If you see the balance sheet, there will be no impact of ESOP at all. ESOP will come into the picture when that options are exercised and that become part of your capital. So you don't need to allocate any separate funds for the ESOP. It's just that whenever you talk to your investors or to anybody on the cap table, they will be treated as a equity shares to consider the dilution percentage and all. But you don't need to keep any funds aside.
Okay, so next question is from Neha. Need to know, is there any formula or any method we should follow to decide how many ESOP we should assign to an employee? So I guess by looking at Jalaj and Hardik's discussion, there is no such formula.
It's the answer to a question. There is nothing right and nothing wrong in the world. So you cannot decide with any formula or percentage how much ESOP should be given to any employee. It's more about your relation with the employee, what kind of role he is in, what kind of performance he is doing, and how much critical he is to your company, and of course the at the back end how much pool you have to give it to them.
Yeah, next question is from Gautam. Whether ESOPs are with voting rights? If so, can there be a differential voting rights?
No, they don't have voting rights.
Till the time the shares are not issued, they don't have any voting rights. They are not a part of a cap table.
Okay. What is the tentative compliance cost for setting up the ESOP pool?
Yeah,
we can meet separately on that.
Yeah,
Hardik,
Jalaj ji can help you with at the minimal cost. So he's into that business.
Hardik, do you have any ballpark figure if you want to share?
So it's actually a no cost. It's just basically a compliance help you will require, a small consultancy, which definitely Jalaj ji can help them. But it is a minimalistic cost we are looking into. It's a very minimalistic cost. There is nothing to compliance in terms of compliance apart from a valuation which needs to be done at the grant date.
Okay, so Neha is asking one more question. Is there a way to link it to their CTC?
So Neha, I give you the perspective here. But maybe right, wrong, we can't comment on that. But how we look at it in the Atomberg is that we don't link that CTC to the ESOP. The ESOP is basically a performance and retention tool for us. So At the initial stage, definitely, it's important when you negotiate with the employee, the ESOP and the CTC both together. And if I talk about the current stage of our company, we don't think ESOP is negotiated with the CTC. CTCs are separate, which are there to meet your employees' day-to-day and expenses. And ESOP is something which we are giving them to as a reward of their own performance and for their basically wealth generation for the future. So it depends on the what stage you are in, but there is no formula of linking ESOP to the CTC directly. It's also about the role, criticality, believe in your future, in your growth story, how much the employee is believing in you. If he is ready to take more ESOP and lesser CTC, that is that he is believing in you more. That is a matter of fact that when you negotiate what you have to give, how much you have ESOPs pool to give away, and at the same time, how much you can afford in terms of CTC to spend on that particular candidate.
Okay, we are at 5:33 now. We will take 3 more questions, then we will close the session. So this question is from Anupam. Do we need to have a space between paid up and authorized capital to be able to create an ESOP?
Yes. Yes.
Okay. So next question, what would be the typical budget that's required for a startup to set up and maintain ESOPs? I guess this has been already answered.
Yeah, that has been covered.
Moving to the next question from Sridhar. When we give the ESOP at discounted price, where do we show the difference of fair valuation and the exercise price of the option?
Yeah, so this is
Sridhar,
basically the accounting. This is the accounting of stock options here, where that difference is seen as a benefit in the hands of the employees, and this will be charged off to the P&L with a corresponding entry in the reserves. So basically, that is how this will work, and ultimately, when we are issuing it, it gets neutralized. So the cost is there, which will be booked like an employee expense above the line, and that will be charged to your P&L. So we need to amortize it over a period, which is the vesting period.
So thank you, Jalaj and Hardik. It was great to listen to you people. Now Vandana will give the thank you note.
So
Yeah,
thanks, Jalaj and Hardik. Thank you for taking out your valuable time. And we look forward to more such sessions in future with you. And if the audience has more such queries, I'm sure they can reach out to Jalaj, and we'll share the email ID with you all if required. So Jalaj, is it okay if we share your details with the audience?
Yeah, that's fine.
So that's it. And to the audience, we are opening a call for application for programs on Nidhi Prayas, Nidhi EIR. You can see it on your screen, and also for 2 more programs call for application for MeitY Grant and MeitY EIR. Please tune in to our social media for more such calls for applications. Thank you once again.
Thank you.
Thank you. Thank you, everyone. Bye.
so much.
Thank you, everyone.